Would you like to contrast that now with one that did work out and how you came across it? What were the metrics, management, CEOs, etc.?
I was trying to pick one for this, and then fortunately, I struggled. And I was trying to think of my most successful investment, and I don't really know is the answer. I think I'm lucky enough to have had some cracking businesses that I've been investing in for, in some cases, over, again, we talked about this in a previous episode, for a good number of years, tens of years, really, and still investing in them now. It made me go back and look at them and think, where did the return come from in those companies?
Hello and welcome to Investing for the Long Term with Judith Mackenzie and Rosemary Banyard. Judith is partner and head of Downing Fund Managers, and Rosemary is an award-winning fund manager who manages the VT Downing Unique Opportunities Fund. In the previous episode, Judith and Rosemary shared how to cultivate the mindset of a long-term investor, including their experiences of investing through recessions. And during this episode, Judith and Rosemary share the highs and lows of a fund manager's investments as they each break down the investments that performed better than they expected and the investments that didn't even come close to what they had expected, resulting in a total loss of capital. This was another great insight into how two seasoned fund managers think and how they view investing for the long term. But just before we get started, please remember that all opinions and information for educational purposes only and do not constitute investment advice. Investing carries a high level of risk and is not right for everyone. Always do your own research and seek financial advice from a regulated financial advisor in your country before making any financial decisions. With that being said, let's get started. Hello, Judith. Hello, Rosemary. Lovely to see you again.
It's good to see you. Hi, Lee.
So this is perhaps one of the hardest things to do for investors, and that's to talk about the investments that don't work out. But we are going to dovetail that with investments that have worked out. So hopefully it's going to be a very good learning experience for the audience. Should we start with the ones that didn't work out? Or should we start with the ones that did work out? Where do you want to start, ladies?
Let's get it over and done with.
Get it over and done
the
with.
difficult ones first.
Get the
Yeah.
difficult ones. So here's the next question then. Who wants to go first? Who wants to share the ones that didn't work out?
I'll go first.
Okay, Judith.
So get your tooth out, isn't it?
Yeah. So yeah, investments that didn't work out. There's so many great learnings we can take from them, and that's what we're trying to hopefully get across here. So Judith, can you please share a company that didn't work out as well as you expected and the reasons why?
I'm going to fudge the answer a little bit to start with. We've talked about this before, and fund managers are no strangers to failure. And I think we talked about resilience in the past as well, haven't we? And I think this is part of that answer to a certain extent. There's a stat that says, I don't necessarily believe it because it really does depend on quite a few assumptions, but it says that if a manager makes over 60% of their calls, then they're going to be top quartile, top of the pack. Now, it is very subjective, obviously, but what it does tell you is that you've got to be used to having some failures. And if you don't, then you're probably going to find it pretty tough to be a fund manager. So that's me preparing the scene with a few sort of excuses. And I think I'm going to talk about one company where there was a permanent loss of capital. There's obviously a difference between a share price that doesn't do quite what you think it's going to do and a permanent loss of capital, which is when actually a company ends up going under. I've had a couple in my career. I'm going to talk about one of them. It is also worth pointing out that our funds, or some of our funds, have been really quite specialist, almost like special situations where we're taking between 5 and 30% of a company or 25% of a company, and we're actually looking for some kind of change to facilitate some kind of change. So I think Rosemary's used the phrase turnaround before when we've been talking about companies, and quite rightly, Rosemary tends to steer away from investing in turnarounds, and probably for this very reason, actually, because they do tend to be quite difficult to get right. These tend to be companies that are maybe not quite performing in the way that you might think they should be when you're first investing in them. But the company that I invested in was a business called Redhall, and they were a specialist engineering business at two different divisions. They were both geared to the nuclear industry. One was a business that created and made the blast-proof doors for going into nuclear plants, but not just nuclear plants, also submarines and any facility that you needed something that really was a strong blast-proof container. So very specialist engineering. The other business that they had was for kit that helped remove nuclear waste for decommissioning nuclear plants. One of the things that saw it was quite attractive at the time was that their order book was really significant. And this was contracted order books for contracts like Hinkley Point. And this is going back maybe about 6-7 years ago. So Hinkley Point was just coming on stream, and there are significant contracts around the build of that. So I'll tell you what happened first, maybe, and why we liked it. It was a management team that had been in place for probably about 2 or 3 years. They seemed well established. They were executing on these contracts. So it was already beginning to flow through in terms of contracts and revenue and profits, always going well. But I'm going to say this with a benefit of hindsight to a certain extent, was that Red Hall were a subcontractor. So they didn't have the direct contract with Hinkley Point for the build of these glass doors and wherever. They were maybe further down the pecking order. And what that meant was, although they had these contracts, there were delays in the contracts, which you always get with big builds, but also the terms that they'd entered into the contract on were quite onerous from a cash payment point of view. So they were building these bits of kit, having it sitting in their forecourt, but because of the delays in the contract, they were swallowing up working capital, cash, to build all these blast-proof doors and other contracts that they had. And quite literally, they got themselves into a really difficult situation where they'd ended up gearing up and still consuming cash. And again, with the benefit of hindsight, had not gone back to the main contractors and renegotiated terms. They were effectively at the tail end of getting paid. And in the end, it was HMRC, and for actually quite an insignificant amount in the whole scheme of things, for about £500,000, HMRC had just gone through the pain with British Steel, didn't like heavy engineering, saw the risks associated with it, and they pulled in their PAYE that had been owed by the company, and that brought it under. And what's slightly galling, in fact, more than slightly galling, is that we knew that the quality of the businesses was good. And we know that with a degree of a lot of confidence now, because it went into administration and got bought out by another company that we own called Avingtrans. And Avingtrans bought the company from administration for about £2 or £3 and have made a cracking business out of it. So it was actually our management team, a degree of mismanagement, and I'll maybe talk about some of the warning signs in a second, that had led to that onerous contract being taken on bad terms, bad payment terms, and nothing to do with the quality of the company and its market positioning. Ironically, we are now benefiting from having bought it cheaply, and it's one of the main assets that now sit within Avingtrans, and I think it'll probably get sold in the next few years at a fantastic multiple, really showing that the company could really do what we thought it could at the start. What have I learned from that? Very wary about subcontractors and very wary about trophy contracts. And with the benefit of hindsight, and again, looking back in the rear view mirror to a certain extent, we could see that a small AIM company had wanted to raise capital and knew that they could probably only raise capital if they won the big contract, were probably too desperate to get it across the line and signed on terms that were too onerous. Could we have found that out at the time? We probably could have done if we'd pulled apart the contracts. We certainly asked the questions. We wouldn't have got access to the underlying contracts, but some of the signs were there. When the business was sold to Avingtrans and the management team of Avingtrans came to see me, they were probably a little bit embarrassed knowing fine that it was us as a major shareholder that had been quite heavily punished through that Red Hall experience. When they came to see us, they said one of the things that when they were doing their diligence in the company that they knew was a warning sign was that there were lots of accidents on site. And there's an official thing called a RIDOR, RIDOR, which is basically a regulatory requirement for companies to keep a record of any serious accidents. And when they looked at the accident rate on the site up in Burnley, there were people tripping over things and not following processes at every corner. So it was a really high accident rate. And the point that the Avingtrans directors made to me was that when you see that, you tend to have a business that isn't well run and people are not taking pride in their jobs, and use that as one of your warning signs. And I do now. I ask that question pretty much of any company that has got housing or a big site facility or wherever, and it's a number that they can't run away from. So yeah, rather cathartic having talked through that. But yeah, it was painful. We lost £5 million on that. Big deal.
Yeah, that's quite significant, isn't it? And what a really detailed explanation as well. Thank you. And how interesting that off the back of that, you now have a new rule. What's your RIDOR numbers?
Yeah.
So that seems a big loss for a lot of people who are listening to this podcast, I'm sure. So thank you.
It was.
What about you, Rosemary? Have you got anything along those lines?
My time has come. Yeah. So interestingly, I was also going to talk about a business failure. It's interesting, isn't it? We are in an industry where the definition of risk held to by, for example, wealth managers, financial advisors, is often volatility. So when they're asking a private investor who they're about to sort of advise what level of risk tolerance they have, what they're talking about is usually how volatile do you want your investments to be. And while that may be important for some, my assessment of risk is really the risk of business failure. The risk, as Judith said, of wiping out your capital permanently. So to me, that is true risk. But occasionally it happens, not so often in public markets, because before things get to a desperate state, more often than not, the company will come to shareholders and ask for extra money, and that may come with the price that management gets changed or whatever. So these things are relatively rare, but they do scar us and they do teach us things. So my company goes back further, and actually it's one that Judith knows too. And it was a small company that I owned when I was at Schroders, and this probably goes back 15 or more years. And it's called Romag. And Romag was based in Consett in County Durham, where it had a manufacturing plant, and it was making specialist glass. It was, for example, making bulletproof glass and a glass that was very resilient to being damaged. And so this glass was and is widely used on trains and tube trains. And so one of the things about Romag and the fact that it actually went into administration is that not only is that etched on my memory, but its name is still etched on a lot of windows of trains and tubes. So I'm standing on the tube regularly. Yeah, it's that bad. And I'll see a little sign that says Romag, and I think, ouch.
No, that's
ouch.
a constant reminder.
It's a constant reminder. Yeah. So what happened? So it was, I'd say, a nice little business getting on and doing what it was doing. It wasn't, I think, particularly expensively valued. Unusually for an engineering manufacturing business, it had a lady chief executive, very experienced, and it had an entrepreneur as chairman. So what went wrong was that they decided that they were going to diversify using their expertise in glass manufacture to get into what was then a very early stage industry in photovoltaic glass panels. Very exciting, huge growth potential. And so they set up a manufacturing line in this factory and started to make PV panels, solar panels. And my recollection is they had some yield issues, as you do with new lines. And so it was not the easiest thing to do. But the big problem over time really was that this industry, frankly, went to China. And so the Chinese put money behind it. They had enormous scale. And a little company in Consett, County Durham, frankly, didn't really have a hope of making a success of this. The investment that they made in this basically jeopardized the whole business, and it went into administration in April 2011. And I did just look up, because you can look up the administrator's reports, and it took 4 years. They completed the administration in 2015, and the bank, who had lent them £17 million, ended up getting 7 million roughly back. So there was never anything left for equity shareholders. Like Judith's example, I don't know the situation as we speak today, but looking it up, it appears that a Swedish company bought the factory as recently as 2020. And so I think that it probably still kept going and has kept going in its core business, which was pretty specialist. So there was one other tragedy in all of this, and I don't now remember exactly when this happened. I think it was before the administration, though. But the lady chief executive very sadly got breast cancer and died. So I think they also had the struggle of going through difficult times without their historic head. I think the lesson here is around diversification. And I know, if you go back decades, actually, the Harvard Business Review did a very famous piece of research on diversifications and came to the conclusion that 75% of them failed. And there's been other work that says if you start a sort of new product line, it can take 7 or 8 years to make a positive contribution. For a small business to do this is probably just the wrong thing to do. And so that's something that we all need to be vigilant about. And it's difficult because sometimes companies will come up with an idea and it seems like it's very close to what they're doing already. And so maybe it's not that much of a diversification and it's not that much of a risk. So I'm not saying these are easy to identify, but I think it's something to be aware of when one hears about a company just doing something out of the ordinary.
Yeah, it's that old adage when a company comes to see you that's a great UK or European operator and they say that they're going to start off in the States and invest in a warehouse and sales team or whatever. It's always been fraught with, I'm not saying it's never worked, but it's always been fraught with timing issues and challenges. If you're further away from your local market, it is quite difficult.
So yeah, it's a valid point. It's something to be aware of, that this new product line that said company is perhaps launching, is it viable? Scrutinize it closely. Is there a market demand for it, and can they be out-competed as this one was by China or other markets? So as you said earlier, if you get 60% of your calls correct, then you're in the upper quartile of fund managers. So you just shared two there that didn't quite work out. Obviously, you've got plenty of calls that have worked out. So would you like to contrast that now with one that did work out, and similar story of how you came across it? What were the metrics, management, CEOs, etc.?
I was trying to pick one for this, and then fortunately, I struggled. And I was trying to think of my most successful investment, and I don't really know is the answer. I think I'm lucky enough to have had some cracking businesses that I've been investing in for, in some cases, over, again, we talked about this in a previous episode, for a good number of years, tens of years really, and still investing in them now. It made me go back and look at them and think, where did the return come from in those companies? And predominantly, because I suppose the share price can go up for two reasons. One, it can go up because its earnings are improving and it's just a function of growth in earnings. The other reason it can go up is it's a function of another fund manager finding it attractive, and the rating, the PE multiple that it's on, maybe going from 6 times to 12 times because there are more buyers than sellers in the market. And when I look back at the good companies or the good returns that we've got from our companies that have gone up in share price by a multiple of times, then it's been because of that earnings growth, not that the multiple has improved dramatically. And just as a couple of examples, and in fact, one company that Rosemary is also an investor in, a company called Traxys. So I first invested in Traxys about 14 years ago, I think. It came out of Leeds University and it had one bit of software at the time. And that was a bit of software that solved the problem for real timetabling. And that might sound like a very simple problem to solve. But if you think about the complexity of the UK rail network, which is actually more complex than many other European rail networks, and indeed that in the US, then it is quite a problem to solve. So this little bit of software created real timetabling software for the train operating companies. And what was nice about that was that the contracts tended to last for the life of the train operating companies, franchises, and they can be anything from 7 or 8 years to 12 to 15 years. So you had software type margins at 70 odd %, but you also had these really nice long-term contracts. So it was a bit of a one-trick pony at that point. I think we were buying it at 38p the first day we bought it. In the last 12, 13 years, they've never issued capital. We've talked again in previous episodes about that return on invested capital. So they were generating, say, £10 of cash profits and reinvesting £1 of it, and then generating another £10 from that reinvestment. So it meant that they were cash generative, and they then went out and started buying other companies in that space where they could sell a solution into the train operating companies or to Network Rail. So really the same customers, but trying to get more of an upsell. And I remember one of the first businesses that they bought for £3 million, I think it was, 2.6 maybe, was a little business called MPEC. And MPEC was responsible for putting little bits of condition monitoring equipment on the line. And it's terrible to say, but you go back about 8-10 years, the only way for the network to know that a signal wasn't working was pretty much when the driver had to sit in front of it for 5 minutes and call in to see if there was a train coming the other way or not. So there was no condition monitoring equipment on the line at all. And this little company, MPEC, for £2.6 million, paid for itself within about 8 months, if I remember, and now is the backbone, or one of the backbones to Traxys as it is today. We've made 8 times money out of it, and if you break it down, 5 times money has been derived from their earnings growth. So although the share price is, it'll be about 9.60 or something today. I might have that wrong, but certainly in this range of between £8 and £9, then, and I was buying it at 45p and I'm still buying it today, its earnings have also gone up substantially and its rating is probably modestly more than it was when we were first buying it. And there's actually been changes in management through the years as well. But if I look back to the success factors, it was focusing on an area, maybe going back to Rosemary's first point on diversification and going into things that you don't know about. They knew who their customer was from the first day that they came out of Leeds University. They knew that those customers had a problem to solve. They knew that the rail industry had been heavily underinvested. And they also knew there were a lot of companies out there that were tiny little businesses based around Derby or wherever, one-man bands almost, who had been providing solutions to the rail industry. So they saw the opportunity for consolidation, sensible consolidation. And yeah, they really have stuck to their knitting, largely in transport and predominantly rail. The only thing that they did, and I think even they admit it now, where they went off the rails a little bit, they bought, I'm going to say events management business. I suppose it is, because it's basically a highways business. If Glastonbury's on, you'll see these chaps and ladies with their bollards on the road and directing traffic. So traffic management is completely different to a bit of software that you can sell into a real franchise. So that's the only acquisition that you think that probably wasn't quite sticking to the knitting. And going back to that diversification point, even now they're saying that maybe we want to dispose of that at some stage. So they've gone back and admitted it wasn't quite perfect. Long story short, we've got companies like that, like Rolex, like James Latham, boring old flooring business, been around forever, that has compounded its earnings and provided some great long-term returns. So I'm not going to pick on any company specifically, because I think when you can get that art of compounding coming into earnings and return on invested capital, that's when it works well.
And Traxys, Judith, are now taking this remote condition monitoring technology into the US market, aren't they? So
Yeah, they are.
We have high hopes.
Oh, albeit they did have a couple of false starts on that. And now I think it's really only now that, touching wood when I'm saying it, yeah, they're now with some of the major railroads companies, they're making a success out of it. But they actually started that process about 5 years ago. So again, maybe going back to watch what markets you're spending too much money on. I'm not against companies going and doing that. It's about the distraction it can cause, and it's also about the capital that it can swallow up as well.
Yeah, it's about the execution of it, isn't it? It's the price is obviously large, but execution could actually really damage the company, couldn't it? I could see all through that Rosemary was nodding and smiling. Is that a company that you've owned as well, Rosemary?
Yes, I own it too. Yeah. We
Well,
don't
many
think
of
when we
those.
travel on the trains about how it all works, but there's a lot of rules and regulations, for example, for train drivers. And so Traxys will provide the rostering software for making sure that the operating companies stick to all the little rules that they have to. And if you get on a train that's late and you claim delay repay, they run all that as well for all these things.
Oh, they do that as well, do they? Okay. Have you got a company there that you want to share?
I was going to talk about a company that's been doing very well for me in the last few years, and it's called 4imprint. It's been on the stock market for years and years. I think it used to be called Bemrose, if you go back quite a way. Well, it's an interesting business because over 90% of its revenues are actually made into the US, and it's headquartered in the US in a Midwest town called Oshkosh, which is, I think, a little further west than Chicago. The chief executive's American, although the FD is English. So what do 4imprint do? They provide kit which companies use as freebies when they go to exhibitions or they're doing an event. Pens, think T-shirts, think water bottles, all the kinds of things that get handed out to put a company's brand in front of potential customers through these items. So 4imprint are in the promotional products business, and their target market is medium-sized businesses in the US. So that they don't do a big deal with a very large corporate. They stay away from that because the margins on that are quite thin. I've actually known the business for some years, but I say not well. But I guess it was appearing on some sort of screens, and I took another look. This is when my present fund started up 2020. And I liked what I saw in terms of the metrics. And one metric in particular, which is important, which is return on equity, or Judith's talking about return on invested capital. They're very closely related. And the return on equity in this business in recent years has been generally between 60 and 80%, which is extremely high. The UK market average is about 14%. And they had no debt, some cash. But it's slightly intriguing because normally when a business has got returns like that, you expect it to have very high profit margins. And 4imprint doesn't, apparently. If you look at the operating margin, it was actually around 6%. It has, for reasons which I'll talk about in a minute, gone up towards 9% recently. But that is still relatively low. I would normally be thinking that a company should have profit margins in excess of 10% if it was a really good business. So this is a really good business, and yet it doesn't have those margins. So why not? So they don't manufacture them themselves. And so they're a distributor. It's a sort of distributor margin, but they do a little bit of added value. So they've got some factories that embroider and do screen printing. So they're putting the company logos onto plain product, particularly fabric product like sweatshirts, whatever, t-shirts. So the crucial thing here is that actually they're very quickly passing this stuff through. So they'll tell a supplier we need 50,000 t-shirts or whatever, and then they'll come in. They might just have them a few days while they're embroidered, and then they go out again. So they're turning their stock and their debtors incredibly frequently. And so that is what is driving the return on capital, which is the crucial metric. And it's a growing business. They've been gaining share, but they still only have low single-digit percentage market share in the massive US market. So I like the numbers. And the other thing I liked is the chief executive. He's an American called Kevin Lyons-Tarr, who joined the business in 1991. Longevity there, which is great. He became head of this division in 2004. He didn't actually become chief executive of the whole group till 2015, but he's basically been driving this business in the States all that time. And yeah, he and his team are very focused, very committed. A couple of interesting things around that. So during COVID, when obviously exhibitions were not happening and therefore they had a big slowdown in demand, they laid nobody off. They're in a smallish community in the Midwest, and they took the decision that they could wear this, they could fund this, and so they didn't lay off anybody. And of course, that meant two things. Firstly, immense loyalty from staff, but also that when things recovered, they were back up and running really quickly compared with the competition who laid people off. So I think that's one thing that I particularly like. And they're just very measured, very straightforward. They're just trying to improve at the margins and just to work at things steadily. I think I'm correct if you look it up that they are pretty explicit that they're not going to make acquisitions. They don't see that there's any point, not major ones anyway, just little bolt-ons to aid what they do. Yeah, and the shares since 2020 have more than doubled, and that's tracking some big increases in profits because they've seen this jump in margin as they have moved away from catalogues to TV advertising, interestingly, and developing their own brand so that they don't have to rely on paying Google for people to find them. They increasingly don't need that.
Yeah, brilliant. I've learned so much listening to you, and especially in this one, it's just how you analyze companies and how you think about what's important in terms of you're more interested in how these companies generate money as opposed to how much money you can make off these investments. It's really been so insightful listening to both of you and how much you love it as well. You're so passionate about it. You're both there nodding and smiling, and as the other ones talk, it's really brilliant to see and hear. And we've still got two more to do as well. We've got portfolio construction and portfolio management to come next. And then I'm looking forward to the last one, which is the day in the life of a fund manager. So we're going to peel back the curtain of what a fund manager does day to day. So really brilliant shares. Thank you so much. And I hope the audience has learned a great deal from investments that work out and investments that don't. So as we finish with all our episodes, we're going to finish with a book to read. So Judith, would you like to go first and share to read?
This episode came around rather quickly, and I've been reading something and I realised it's nothing to do with finance, but you can always link it back to finance in some way up, but it's going to be a little bit spurious. So this one's called It's the Map That Changed the World. And I suppose I'm a little bit fixated on old maps, and I stumbled across this book, I suppose when I was Googling as much as anything else. It's by Simon Winchester. It's a true story based on a chap called William Smith, who was an Oxfordshire blacksmith, and he was a self-taught geologist of all things. And for 20 years, he went around the UK and literally through his own self-teachings, he named the layers of rock beneath his feet. And you probably have all seen geologist maps of certain areas where you can see Jurassic stone, you can see tin, copper or whatever. And it was actually back in 1815 that this first map was ever created. And it was created over 20 years by this chap going round and doing it himself. So completely self-made. It's where you've got that map with all the different colours on it. And if you think about it, that was then taken and it then went into the mining industry, obviously, made the fortunes of tin and copper and iron ore in the UK, and then subsequently went overseas and using that same methodology was used for mining diamonds and gold and silver. But not wanting to give the story away too much, it's quite a sad story because everything was plagiarised. When he took it into industry and showed this map and it was unveiled, pretty much hand done with his own crayons or whatever. He was chastised, he was sent out into the cold, didn't get any recognition for it. And he'd self-funded it. So he ended up getting into quite a lot of debt. He was imprisoned for it. His wife became, I think she went insane actually. And it was really only about 15, 20 years later, when after he'd become quite ill, that he ended up getting recognition for it. It's probably slightly fictitious as well, but it's taking the root of the story. And it's the absolute determination of this individual who taught himself geology and went off and, the map that changed the world, quite literally.
Yeah. Sounds like an entrepreneur.
Yeah, there we go. There's the
Starting up a
tie back to
business.
finance. Yeah, exactly.
Sounds like you were describing the story of a business owner starting up a business.
Thanks for doing that, Lee. That was very nicely tied back to industry. Thank you.
Yeah. Rosemary?
I'm going to go for some podcasts this week rather than a book. And it's a whole family of them, which I dip into quite often. And it is American-centric. But for all that, I find great value in it. And the site's called Colossus, and I think it's joincolossus.com. Their mission in life is to educate people about business and investment. They have lots of excellent sub-podcast families. And the three that I find myself drawn to frequently, one is called Invest Like the Best, one is called the Founders Podcast, and the other's called Business Breakdowns. If you register, which is free, you can also get written articles that are produced, often very insightful as well. For example, on the Business Breakdowns, occasionally they'll do a UK business, but it's more US centric. But one I listened to recently was on Rolex, and you can't invest in Rolex. It's owned by a very secretive, private, I think a charitable organisation. But these things are absolutely fascinating, and you can listen to one of these for an hour or so and learn an immense amount about an industry that you don't know anything about. So one thing I learned about Rolex was that they've got a factory in Switzerland where something like 5 of the floors are underground. So if you drive past, you think it's a much smaller company than it actually is. It's an interesting fact.
How's it going to those extremes to hide how big the company is? For sure. Yeah. As always, I will make sure those links are just below in the show notes. So if you do want to check any of those out, you can just scroll down and they'll be there for you. Well, that's it for today. And in our next episode, Judith and Rosemary will share some of their most memorable meetings with management and CEOs, the good, the bad, and the ugly. Some networking stories and their thoughts around attending AGMs. It will be another insightful episode that reveals how 2 seasoned fund managers think and how they view investing for the long term. And if you want to learn more about Judith and Rosemary and Downing, please visit www.downingfundmanagers.co.uk. All the links are just below in the show notes. If you like what you heard, please subscribe and leave us a comment. The more feedback we get, the more value we can offer. With that being said, thanks for listening, and we look forward to speaking to you in our next episode. Have a great day and bye for now.